there's a massive amount of capital available, which we're seeing presented to the Medibank private float. So there's a massive demand for anything which can provide a reasonably stable yield. So the capital's there, just a matter of the government coming up with a way of raising that capital rather than selling an asset like Medibank Private to move into infrastructure.
Now there's something like a $700 billion shortfall in terms of money that could be earmarked towards infrastructure. Why isn't the huge pool of savings we have in Australia now going towards that?
I don't know whether the self-directed market is sophisticated enough. I'm sure the industry funds have created their own infrastructure investment funds and they're doing private infrastructure. There's a real gap for self-directed retirees, and now we're talking $600 billion in self-managed. There's a real gap in the offer of products to them. Now we will see David Murray's inquiry. He's flagged that there's a couple of things wrong with the super system. One is the focus on yield in the stock market, Australian equity focus, and the other one is the lack of annuities, that there should be more annuities offered. Now the best type of annuity is an Australian government bond, and if you index it, then it's a great annuity, much better than what's being offered to people today. So the funding is there, we've just got to join the dots, come up with a product and get going. So it's quite exciting when you think about it.
So that means the government, though, would need to create effectively an infrastructure bond.
Yep.
I mean, they could do that tomorrow, couldn't they, really?
Well, they could do it, and it would require a market mechanism. You know, the ASX is sitting here in a marketplace. I can't understand why government bonds are not listed on the Australian stock market. That would be the best place for it, so people could probably buy $1,000, $10,000, $100,000 bonds priced by market makers who know where the market is. That would be a great thing for Australia. And I would suspect, also you've got to understand this, I think the latest figures I saw was about $100 billion of self-managed funds sitting in cash accounts. Now clearly they're underperforming cash with 3% yields, if not lower. So you're going to present to people who are parking money in banks, which would call very lazy capital, and give them a higher yield, but that capital is then taken and reinvested back in the economy to build something of importance to the country. So that's why I get quite excited about this. I can't work out why it hasn't happened yet.
But of course the big question people say is that, well, if you do that and the government raises infrastructure bonds and money via that system, that you end up having the government picking winners, which a lot of people are a bit nervous about.
Well, no, the government doesn't have to pick winners so much. It's actually got to invest capital, which is being granted to it by the population, and get a higher return on it than they are paying for it through the interest rates. Also, there's a social need. You know, we've got to build roads, we've got to build airports, we've got to build hospitals, we've got to expand universities. We've got to build all that infrastructure required to grow our services to the Asian region. So tourism's another thing. If people can't get around Australia, they won't come here. They can go to Europe and get around Europe pretty quickly. To come to Australia, it's a struggle. Coming in and out of airports, going on roads, getting anywhere. So you will get a payback. And you've got to think about payback not short term, but long term. The compounding effects of infrastructure investment are quite profound.
And I can imagine that a lot of people who invest in these would feel quite proud about the fact that they're investing in new ports, new roads, new airports, for instance.
Absolutely. Well, you get a lot more comfort out of that than putting money in a bank and getting paid an interest rate which doesn't even match inflation at present. I think that's cruel. That's the world we live in today. I guess that's why the G20 is talking about infrastructure, because the world growth is so low. We're getting very low interest rates. There has to be a break. Now, the G20, with the greatest respect, isn't going to think about Australia's problems. Australia is good to be in a debate about world problems, but we should really focus on our issues. And we have an issue of infrastructure, but we have a massive savings base, which is not being tapped.
And I guess that the last time something like this happened was during the war. I mean, war bonds is a similar idea, right? You invest in your nation. Correct.
Yeah. And there's been, I have another thought that maybe if we can't get super funds investing in bonds, well then maybe we should direct them to. And you could come up with a scheme which has occurred in the past where super funds were directed to buy bonds. We've had this burgeoning self-directed superannuation market. I would suggest that this self-directed market actually needs direction. I think we're kidding ourselves that people can manage $600 billion by themselves. They need help. And the government could well come in and say, look, to be a complying super fund, you need to have 10 or 20% of your assets in bonds. That would be sensible because that's a steady returning asset. It's not volatile. The country needs the capital's lazy. And if we do have a market meltdown in equities like we had only 6 or 7 years ago, you'd find that the bonds would protect a lot of these portfolios from meltdown. So I think there's a lot of ticks for it, actually.
Well, let's hope that it ends up in the G20's agenda. John Abernethy, thanks very much.
Thanks.